Will easing monetary policy, along with tax cuts and deregulation, drive stocks higher? Or will lofty investor sentiment, combined with trade wars and elevated inflation, drag equities down? I'm Brad Neuman, Alger's Director of Market Strategy, and in this video, we discuss bull and bear points for the economy and stock market. Bull point number 1, only the beginning? Economic expansions in the United States have been increasing in duration, owing to number 1, a more prominent central bank, 2, the economic evolution from manufacturing to services, and 3, improving technology. Lengthening expansions are shown on the chart on the left, where the dots move higher on the vertical axis, which shows duration of each economic cycle as we move further in time to the right. Current expansion is under 5 years old, which is significantly shorter than the 9-year average of the prior 3 expansions, implying that we may have several more years of economic growth ahead of us, in our view. The chart on the right shows the historical average of the S&P 500 returns in light blue after Fed easing in the absence of recession. This is based on easing cycles that began in 1984, 1995, and 1998. As you can see, monetary easing with no recession has historically been supportive of a rising stock market. If the current cycle were to resemble the historical average, could this imply more U.S. equity appreciation? Bull point number 2, follow the leader. As a key input to the cost of money for businesses and consumers, the federal funds rate has a strong impact on the economy. Historical episodes of significant rate cutting are highlighted in this chart. What we observe from these periods is that as interest rates move down, indicated by the dark blue line increasing, corporate profit growth began to accelerate in the following quarters. If history repeats itself, we may see faster earnings growth over the next year or so, which may support stock prices. Bull point number 3, lower taxes. Lower corporate tax rates generally serve to increase corporate earnings and cash flow, which enables businesses to spend and hire more, helping the economy grow. This virtuous cycle may have contributed to accelerating economic growth in 2017 and 2018, which was the last time Trump and the Republicans controlled Congress, which passed a reduction in the corporate tax rate from 35% to 21%. As shown in this chart, corporate earnings growth accelerated from flattish to strong double digits. Real GDP growth also accelerated from 1.8% in 2016 to 3.0% in 2018. Corporate tax rates may decline over the next couple of years with several potential changes, including 1. Corporate income tax reduction for domestic production, 2. R&D expensing, and 3. Bonus depreciation. These changes could boost corporate earnings again, providing a tailwind to equities. Bull point number 4, deregulation. New regulation over the past 2 decades costs approximately $3 trillion, according to the American Action Forum, making it routinely a top 5 concern for businesses, according to the National Federation of Independent Business. When Trump and the Republicans controlled Congress in 2017 and 2018, new federal regulation, measured by paperwork hours, posted the lowest growth seen in the past decade, as shown in this chart. With promises to roll back regulation again in the current term, regulation may become less of a concern for companies, boosting business confidence and spending. Bull point number 5, AI progress. Artificial intelligence has been one of the key drivers of stock returns over the past couple of years, so investors are understandably focused on the sustainability of investment and continued technological progress in this area. In contrast to the tech bubble of the late 1990s, when the companies building out the internet were free cash flow negative and relied on debt financing for growth, today's AI providers are free cash flow positive, as shown in this chart on the left, and have net cash positions. To us, this means that today's AI build-out is far more sustainable than the internet bubble around the turn of the millennium. Continued investment in AI is likely to lead to smarter and more capable models based on the established historical relationship between AI training and measured intelligence, as shown on this chart on the right. Bear point number 1, lofty sentiment. Investor sentiment, which has often been a contrarian indicator, is elevated. The chart on the left shows consumer sentiment for stocks, with the percent of Americans expecting increases in the next 12 months, just off the record set in November of last year, as indicated by the red circle on the right. Now this comes after the same sentiment measure was very low in mid-2022, as shown by the red circle on the left when the stock market was weak. In retrospect, of course, that was the time to be bullish, given the next 18 months produced a total return in excess of 20% for the S&P 500. The chart on the right shows another elevated investor sentiment metric, fund flows, which hit very high levels following the election, in contrast to the weakness seen in 2023 as the stock market was beginning a strong recovery. Bear point number 2, stretched valuations. One manifestation of the lofty sentiment is high valuations. The S&P 500 price-to-earnings ratio is more than 25% higher than its average since the mid-1990s, as shown on the chart on the left. On the right, we show a measure favored by Warren Buffett, market capitalization to GDP. Whether we look at the S&P 500 relative to US or global GDP, we see what looks like stretched valuations. There are at least 2 caveats to what appears to be elevated valuation. Number 1, free cash flow generation relative to earnings has increased over time, making stocks look less expensive on that metric. And 2, some areas of the equity market, such as small cap growth and mid cap growth, appear more attractively valued. We expand on both of these points in our full presentation. Bear point number 3, trade wars. Donald Trump has called tariffs, quote, the most beautiful word. In this chart, we show the historical US weighted average tariff rate, along with an estimate of where tariffs could go if Trump followed through on 10% across-the-board tariffs and 60% on China. The resulting tariff rate would be the highest since the 1930s. And while that may be unlikely, a material increase in tariff rates is likely negative for stocks in that it could reduce corporate profitability for domestic businesses, while overseas retaliation may hurt exports, all the while producing higher inflation, which may keep interest rates higher for longer. Bear point number 4, higher inflation. There are signs that inflation is stubbornly refusing to bow to the Fed's wishes and retreat further. On the left, we see producer price growth is accelerating. And on the right, we see consumer price inflation has appeared to plateau at levels over 100 basis points higher than pre-COVID rates of growth. As we mentioned, elevated inflation, potentially exacerbated by rising tariffs and lower immigration, may reduce expectations for monetary easing and serve to increase interest rates. Bear point number 5, bonds balk? Bond vigilantes can dictate policy. Just ask Liz Truss, the shortest serving prime minister in British history, who held office for just 49 days in late 2022 before resigning due to widespread backlash in the bond market against her economic policies of tax cuts and deregulation. The US bond market may also balk at policies that lead to higher deficits, given the deteriorating fiscal situation in the US. After all, the fiscal position of the US government is very different than it was in 2016 when Trump was first elected. US debt relative to GDP is up 30% since then, as shown on the chart on the left. And the US deficit relative to GDP is more than double what it was. The chart on the right shows the federal interest payments relative to GDP are expected to hit unprecedented levels and continue increasing far into the future. The big question for investors? Whether the bond market will protest spiking rates and punishing stocks in the process. At Alger, we believe that industries or technologies early in their life cycle are less susceptible to economic volatility because of their potential for market share gains. In our view, these areas, such as life science tools, generative AI, and cloud computing, may be able to grow irrespective of which of the aforementioned bull or bear points come to fruition. Once again, I'm Brad Neuman. On behalf of all of us at Alger, thank you for your interest.